Valuation is an opinion. Enterprise value is what survives under due diligence and scrutiny. A lot of companies are chasing unicorn valuations. They're chasing Series A, Series B, Series C, but that's not always a good thing. Sometimes these companies sacrifice business fundamentals in order to reach the next funding round, and sometimes there is no sustainable business model at all. This can make sense in certain instances. Think about deep tech, think about long-term investments that will only really be unlocked once certain regulations change or when something is happening in the market or technology reaches a certain level of maturity. But it seems like too many companies are playing that same approach, even though it is not very suitable or reasonable in their industry to use it. We all know it comes from the 2020s, the unicorn era, the era of inflated valuations. And some of those outdated models or outdated goals are still with us and are still being perpetuated. Now, this can really break a company's neck. If a company is not built on strong business fundamentals, but it's built on investor optics, depending on what the investors expect. Top-line growth, aggressive market share, expansion into new markets, that costs a lot of money. Sales and marketing costs a lot of money. Establishing new offices costs money. You don't see immediate returns. Your burn rate is probably very high, sometimes intentionally. But it means you're not running a sustainable commercial operation. The moment the external funding dries up and is not available anymore, you will face challenges paying the salaries of your employees. You will face challenges paying your marketing costs. You will face challenges keeping the lights on and paying the rent of all of your offices that you had to buy in prime areas in order to show that you're a real company, that you're a serious company. So there's a point and a case to be made for shifting gears into building structurally sound and reasonable businesses based on business fundamentals. And what does that look like in practice? In enterprise value, we are really looking, as a concept, we're really looking into what is the value of a company if the founders step out? What is the value of that company as a transferable asset? An asset that can be transferred to a new owner. Can this unsustainable sales and marketing machine that is in 16 different markets, can that survive a transfer? When the founders step out, when the top executive leaders and top 10 leave the company after the acquisition, that's not transferable. So when we are building companies, when we are working with companies to focus on enterprise value, we look at a couple of things. The first is aggressive revenue growth is amazing. It's certainly a measure of success, depending on how it's being done. But what matters even more is retention. Can we retain those customers? Do they buy something from us again? Whether it's the same product of the initial purchase or a different product within our portfolio. Are they loyal? Do we have a recurring business model, which means do we have memberships or monthly payments that the clients are paying? Or is it only one-off transactions? Now, that distinction is important because if your business model is only built on one-off transactions, that means every single time you spend money on marketing, every single time you spend money on acquisition, sales commissions, whatever it is, you are now getting a transaction once and that's it. Every single time you want a new transaction, every single time you want money to come on your bank accounts again, you need to invest again in marketing, again in sales commissions. Retaining and keeping customers with you means that you spend the marketing money and the sales money once. And then you keep getting revenue to your bank account repeatedly at way less cost of customer acquisition, right? So now you use either your customer success team or it's completely product-led through notification, whatever it is, but the upsales are happening now in a way more cost-efficient manner. The revenue that you're getting from those repeat customers is way more efficient. Because often the most expensive part of the customer journey is to actually acquire the customer for the first time. So if you don't have a recurring revenue model, can you build one? What would it take? Does it need your product team to get on it? Do you need to change things in your back end? Do you need to be creative? Do you need to look at your industry? What are common practices? So that's a huge piece. How efficient is your revenue engine? Now, the unicorn investors will probably look into, just show me the sales. I don't care about your marketing spend. I don't care about your sales costs. Just show me top line growth. We take it from there. You can figure all of the stuff out later. We just give you another few millions. Again, can be great as a temporary tactic, but definitely not a suitable long-term strategy. Now you go a step deeper. I acquire customers. I make revenue. Looks amazing, right? My sales team is crushing it. Like, I have top talented people. They love what they do. They love being part of the company. They hit sales record after sales record after sales record. But why is it that every month we are still worried about paying the salaries? And why is it that we are now confronted with terms like run rate, which is basically how much oxygen, financial oxygen, we have left before we run out of money, which would be the equivalent of bankruptcy? Why are we worried about all of these things despite having such amazing sales results and our sales team being on top of the world? Well, the reason is, of course, your costs, your cost structure. Now, for growth stage companies, and sometimes even mid-market companies, it's not always easy and straightforward to have a full level overview over all of your costs that are related to units, to each sale, but also to your revenue in general. And especially if you're operating in multiple markets with different currencies, different bank accounts, you don't have unified accounting because you just grew really fast. And now you need to retroactively build everything and adjust it. It can be quite challenging to actually have accurate numbers on this. And it just happens by design, by default. It's just the nature of growth, of scaling, of being fast on the market. Of course, there are always ways of doing it in a more step-by-step and structured manner. But sometimes you see an opportunity, you just rush into it, you take advantage of it, and you figure out the details afterwards. So sometimes, yeah, you do have growth stage companies, mid-size, mid-market companies who don't always have the entire overview of their entire cost structure in a clean and neat format. And often stakeholders in the company don't even have the bandwidth to care about this because the next sales milestone needs to be met. There are PR topics to be taken care of, investors conversations to be had, and so forth. We would just hope that the accounting team somehow has it under control. And so what you then see is you actually need to build systems that capture properly the costs per unit and also capture the actual cost of customer acquisition, which is your marketing and sales costs. Again, in another sometimes there are variations to this. Some people add additional metrics to it. But you want to have an overview of your cost of customer acquisition. And you are sometimes probably surprised why companies would give out $500 vouchers if you refer a friend, which seems like a lot. But if you had any idea how much money those companies are spending on marketing and sales typically to get a customer, then those $500 that they're giving to some referrer are actually still a good deal for the company. And so once you understand your cost of customer acquisition, you also want to understand your costs of goods sold, which means whatever product you're selling, the moment it's being executed or being used by the customer, there will be costs in its operations. If it's a software product, right, there are different costs compared to a service, to a physical product, and so forth. Now, it might sound like common sense, like why do you even need to mention this? But keep in mind, many companies often do not have the data infrastructure to see those metrics in real time. They know theoretically what those metrics are, but the level of precision is often off until you actually build a proper data infrastructure, the data engineering and data analytics. And now there's a challenge that goes into this because data is something I firmly believe in is highly political. Often when you grow really fast, departments and markets have ownership over the data. They curate the data. They send back the data to the HQ or to the central function, to the accounting, to the finance team, to the finance department. And so how do you actually know that this data is correct or is that it's complete? Even if every single stakeholder had the best of intentions, do they even know what to look for, what to track? How are they calculating costs of good? How are they calculating conversion rates? In sales, how are they calculating their marketing efficiency? It can be that different departments, different markets have wildly different calculation logics. Do we even have a shared glossary of what each metric means. And this becomes important when we speak about enterprise value, because if you don't have a clean data room, if you don't have a clean overview that is ready to show, then you will pay a discount, or a discount will be applied to your value based on this information that's missing, based on anything that looks chaotic. You will be in a stronger negotiation position. You will have way more leverage when you have this data under control in real time on dashboards in a clean and neat format with clear data entry sources where you can trust that whatever you're looking at is actually precise. And you'll be surprised how often it takes deep dives and deep digging to actually adjust the precision of many of those numbers, because wildly different calculation logics were used, but there was no standard of actually consistent data entry and data collection. Now, once you got your data under control and you have an overview over your costs, now you can actually look into your gross margins and your contribution margins. Again, the unicorn era didn't care much about this. It actually often intentionally said, don't care about these things. We just want to see aggressive growth. For many companies, post 2022, when inflation hit, there was a huge shift in gears to actually start making these metrics part of leadership discussions, part of the company's strategy. And keep in mind, a company is a commercial organization. It pursues commercial goals. So if a strategy deck is full with shiny object projects, is full with PR campaigns and with new employee benefits, well, this has its legitimacy, and it doesn't add anything about the commercial reality of the company or about the commercial metrics, then there might be a problem. There might be a misunderstanding about what the company is here to do. And again, you can take this to an extreme where you see a company only as a money-making machine and that's it, growth at all costs. It's of course one extreme, but you can also take it to the other extreme where you treat your company almost like, I don't know, an institution that's supposed to serve you. And sometimes people who spend a lot of time in universities and academia come with that attitude into the job market, into the private sector, where they think that companies and organizations are primarily there to provide for them. There's no notion of that there is a process of mutual value creation involved between leaders, employees, the company, the organization, the customers, that you either add value or solve problems for the market. And that's what you get financially rewarded for as a company. And if you do it really well, you get rewarded even more. And so you put the customer, you put actually the solving of problems, the adding of value, addition of value in the core focus. You run a very different company than one that is either chasing investor optics or that is misunderstood as a social club or misunderstood as a providing entity that is supposed to provide for all of its employees. A company that's financially and commercially successful still provides, but the priority and the sequence of priorities must be clear. And that also matters for enterprise value, because in the end of the day, investors or acquirers in this case, and those who would create a liquidity event, actually where you have a real payday, they will also look into how sustainable is that revenue that you currently have. Will it all dry up the moment key people are not involved anymore? Are these only one-off transactions? Like, is this sustainable? What do the margins look like? Contribution margin, gross margin, like, is that actually an attractive business model? Now, some strategic acquirers might say, I don't care about any of those commercial metrics. I want their customer database because I own a company that can upsell a different product to the same customers that they already have. And I can just make more sales with my other company if I buy this company. Okay, in this case, doesn't matter much. There can be companies that are strategically positioned. Think of the acquisition of YouTube, which was not doing really well in terms of commercials. It had a lot of lawsuits going on, and yet it was acquired. And think of WhatsApp and other companies that were acquired despite not having the greatest business fundamentals. Sometimes companies get acquired because of their user base. Sometimes they get acquired because of their top talent. Sometimes they get acquired because of their technology, their IP, their intellectual property. But this is really the exception. This is not something you can count on and bet on unless you have existing relationships with potential acquirers and they tell you, deliver me 1 to 3 and then I'm going to buy you. But for most companies, that's not the case. So if you want to run and build a proper commercial enterprise, then you need to look into your actual efficiency metrics. And lastly, what you want to look at in terms of enterprise value is how dependent are you on key people? Are there certain people in your sales team that are driving all the revenue? And what if they left? Are there certain people in your engineering and product team that have all the institutional knowledge? And if they would leave and go to a competitor, the company would fall apart because it could not maintain its current product. It could not build up on it. What about the founders? Are they involved in every single decision? Did the organization ever learn to make its own decisions based on the context, the situation that they're in? Or do they all wait for orders from above? What if the founder steps out in the moment of an acquisition? Is their company still going to produce the same revenue? Or will it lose its enterprise value? These are things you need to look at. And this is, of course, let's call it a bit more boring work compared to chasing unicorns and being at press conferences and at fancy dinners and investor events. That's the actual work that needs to be done in the background to run a proper business that you could sell if you chose to, but you might as well not sell it. You want to have options. The more optionality you have, the more different paths you can take, whether it's selling to a private equity firm, whether it's selling to a strategic acquirer, an IPO, the more options you keep open by not inflating your valuation, for example. The more doors you keep open, the more valuable you are. The more optionality you have, the more room to maneuver you have. And that's the work that we do at StrategicRX. We work with companies who are beyond the hype cycle, who are past the unicorn craze, and who are interested and committed to building proper businesses based on proper business fundamentals.